Is this the new stock market crash? Hey everyone, welcome back to FiscalVoyage. My name is Felix, and in today's video we're going to talk about the stock market crash of the September-October time period and see if the stock market is going to go even lower, and if it's going lower, is there current companies that we could buy now at current prices that are undervalued even though the stock market is overvalued. So in this video I'm going to go through 8 different companies that I see that are undervalued, and there's a lot more other companies that's undervalued, but in this video we're going to cover 8 companies that I see that is undervalued and present a great buying opportunity with total annual rate of return projection of about 20+% for the next 2 years. But before we get started with this video, if you're new to the channel, make sure to hit that subscribe button and make sure to hit that like button as well, because for the YouTube algorithm, and check out my free ebook in the description below, 5 quick metrics to look for before spending more of your time in investing into any particular company. So as you can see here, S&P 500 is down today over 2%, and it's been down since you see here September 2nd. Since September 2nd, the stock S&P 500 has been down 9%, so almost 10%. It's a very nice correction here. It gives us a lot of opportunity. And in this video, like I mentioned, I'm going to talk about 8 different companies that are undervalued, and with this market down today, it's even more undervalued since September 2nd. So let's get into it. So here's a fast graph for the S&P 500. As you can see here, the market earnings is expected to be at $130 a share for the S&P 500, which is 19% down than 2019 of $162 a share, but picking up at $165 in 2021. But you can see here is overvalued based on the 2020 expected earnings as well as 2021 expected earnings, but fairly valued to expected 2022 earnings. So a lot of people are expecting S&P 500 to provide very minimum return year over year because of the fact of the high valuation where it is currently at about a 23.8 PE, and this is from Friday's closing price. So as you saw, it's down about 2% today. And you can see here, if we were to go to its average PE of 18, you can see you only will be making about a total annual rate of return of 4.3 based on 2022 expected earnings of $189 a share. So let's look at the 8 companies that are undervalued and present a better rate of return, annual rate of return, than the S&P 500. The first one here is Altria Group, ticker symbol MO. As you can see here, earnings has been tremendous throughout the years, growing very nicely. And even this year is expected to grow about 2%. And you can see here the black line is the monthly closing price. And based on that, right now the company has a PE of 9.28 or 9.3. This is again based on Friday's closing price and is down today. But if we shorten this time period, as you can see, earnings growing here. And if we were to go back to a normal multiple of about 18, which is very unlikely, but let's stick with a multiple of 15 based on earnings, you have a total annual rate of return of 36%. Including that 36% is a great dividend yield of 8.63 currently. So it gives the company a adjusted earnings yield of 10. You like to say this at 6.5 or 7 and higher. So this is 10.77 earnings yield. The company is BBB credit rating. The long-term debt to cap is pretty high, but it's still manageable because the company does have plenty of free cash flow to cover the dividend, as well as the debt. So you can see here the free cash flow is higher than the dividend. It might be down than 2019 at $4.06 a share. So there isn't an estimate, but overall it does looks good, and the dividend looks to be covered here by the company. So the next stock we're talking about here is AT&T, ticker symbol T. As you can see here, earnings has been erratic. There's been years where down earnings came and then it picked up and then it dropped here, and this year is expected to drop by 10%. However, you can see here price does follow earnings. As earnings drop, price dropped, and that's why we see earnings drop here and the price drop here. But as you can see here, earnings is expected to pick up in 2021 and 2022 at 2% and 3%. And if we shorten this time period, You can see here the company tends to follow a normal multiple of 13. Right now it has a multiple of 8.75. Again, this is Friday's closing price, so it's lower today. And you can see here you have a total annual rate of return of 25.6%. So it's slightly lower than Altria Group, but it's very much higher than the S&P 500 4% growth annual return for the next 2 years. So 25% for AT&T. You have a very good safe dividend at 7.19. It is probably higher today because the stock is down. And the blended adjusted earning yields of 11.4. S&P credit rating of BBB, so it's investment grade. The debt is much better than the Altria, but it's still, you know, a modest high here at 47%, but doable. So overall, you know, you can see here earnings are expected to be down this year, but picking up again slightly in 2021 and 2022. So much better total annual rate of return versus the S&P 500. So let's go look at the third company. So this is Prosperity Bankshare Inc., ticker symbol PB. So you can see here this is a bank, regional bank, and earnings has been outstanding throughout the years, and even in 2008, 2009, it did dip by 1%, but the best part is the company continued to pay out its dividend. It actually increased it in 2008 and 2009, so that's very tremendous considering like most banks were cutting dividends or earnings dropped tremendously. There's been a few hiccups here in 2016 and 17, you can see here, but 2020, analysts are expecting $5.45 in earnings per share, which is a 21% growth, down 2021 by 9%, but then picking up in 2022 by 10%. And you can see here during the March low, the company went as far down as $48, and we're almost there at $51. So with today's down market, it might be at under $50. So it might present a great buy because from that time period to the high here, it jumped almost 35%. So, and you can see the company does follow earnings with a multiple of about 15. So we shorten this time period. It still follows a multiple of around 15. So based on Friday's closing price, you have a total annual rate of return expected at 25.4% for the next 2 years. Again, much better than the S&P 500 4%. The debt is very low at 3%. It doesn't have a credit rating, but the dividend yield is very nice at 3.58. Adjusted earnings yield at 10.10. Again, much better than the 6.57% criteria. So that's good. Blended PE at 9.9 versus the average of around 15.5 or 16. But I like to be conservative here and just go with a 15 PE average. And you can see the company does have a nice annual total rate of return projection of 25%. So this is another company that's undervalued and presents a nice buying opportunity. Now, of course, do your own research, look further into these companies. But this video is more to show you different companies that you guys could research that are undervalued and maybe, you know, something that you may be interested. So let's look at the next company. So here's Prudential Financial Inc., ticker symbol PRU. As you can see here, earnings has been erratic, but it is growing very nicely. For this year, analysts are expecting a negative 20% earnings drop from 11.69 in 2019 to 9.36 in 2020. Picking up right up at 11.50 in 2021 and then 13.07 at 2022. As you can see here, the dividend was cut in 2008, 2009 from $1.15 to 58 cents, but the company picked it up right back in a few years. You went back in 2007 to 115, in 2010 back to 115. So even if you had this company here and, you know, sold it because it cut the dividend did return back in just a few years. But luckily, right now the company hasn't cut the dividend. The dividend looks very safe, and you can see here a nice annual rate of return about 45%. Let's shorten this time period to get I think a better accurate rate of return. You can see here about a 32.8% total annual rate of return for the next 2 years versus, again, the 4% for the S&P 500. So just because the market is overvalued doesn't mean that there's specific stocks that are undervalued and present great buying opportunities. So here's one right here with Prudential Financial. A great dividend, safe dividend at 6.46. S&P credit rate of A, low debt, 21% long-term debt to cap, which is outstanding. and the blended adjusted earning yields of 14.7, which is outstanding as well, and a very low PE of 6.8 versus a normal PE of 9. So you can see here, this definitely, Prudential presents a great buying opportunity. Again, do your own research, but this is a company you may be interested in, and the current prices does look very undervalued. And the next company that's undervalued right now is AbbVie Inc., ticker symbol ABBV. As you can see here, the company has a nice yield of 5.24, blended adjusted earning yields of over 11%, a blended PE of 9, where it averages around 13. But we're showing this time period. As you can see here, a blended normal PE around 12 or 13, and at Friday's closing price, and it is down about 1.5% today. You can see here we could have a 38% total annual rate of return for the next 2 years, which is outstanding. The dividend is very well covered. I actually own shares of this company, and again, just because the market is overvalued, the S&P 500 is overvalued, doesn't mean that there's pockets of companies that's undervalued and presents and high quality companies at that. These companies that I just mentioned so far are very high quality companies, and you can see they're undervalued, and you could present yourself with a nice total annual rate of return of about 38% with just AbbVie alone. A lot of the other companies we talked over already has over 20% total annual rate of return. So there is a lot of potential to purchase companies in this down market or this high overvalued market. S&P credit rating of BBB plus, investment grade. The debt is high at 80%, but still manageable, and they're tackling this debt level. The next company I want to talk about here is CVS Health Corp, ticker symbol CVS. You can see here earnings has been tremendous. There's only been a flat year here, 1%. 2019, 0% here, but for the most part, it's been positive this whole year, except in 2001 when it dropped 13%. But overall, very positive, and analysts are expecting a 2% for 2020 growth and 4% for 2021 and 9% for 2022. It's a nice dividend, very safe dividend. The only thing I don't like so far about this company is that they froze the dividend for the past few years. You can see here at $2 from 2017 to 2018 to 2019 and this year. But I do expect the company, because they're trying to attack this debt level. But I do see the company increase its dividend once their debt level become manageable. But you can see here blended adjusted earning yields of 12.05, very nice dividend, a P of 8.3. If we shorten this time period to more recent years, let's go here. You can see here the company had more or less a PE ratio around 13. I don't think they'll reach that far, but maybe a PE around 10 or 11 still presents a great buying opportunity. But if it goes back to a PE of a 13 or 14, you can see here you have a total annual rate of return about 34.7%. So tremendous growth potential here based on the valuation. Even though earnings is just going at 4%, picking up at 9% 2022, but because of the company valuation, you are presented with a great opportunity here with high total rate of return of 34.7%. And in the meantime, you have a well-covered safe dividend of 3.36%. So this CVS does present a nice opportunity here. So let's look here at Bristol-Myers Squibb, the next company here, ticker symbol BMY. You can see here the company was overvalued in 2014, 2015, 2016, and then it reverted back to its mean, but earnings has been growing since then tremendously, and now it presents a great buying opportunity. And this is one of the companies that I've been buying for the past month or so recently to stack up because of this high growth potential here. So we shorten this time period to 8 years. You can see here, and if it goes back to a P of around, you can see 21, which is quite high, I think. But maybe a PE of 15. But you can see here, you have a total annual return of potentially a 57% in just the 2 years. So that's outstanding growth. Of course, you can see here 19% earnings growth, 9% earnings growth in 2022, 33% earnings growth expected this year. So this company does have tremendous earnings growth, which then drives up the price. The last company I'm talking here is Tyson Foods Inc., ticker symbol TSN. Of course, with the economic shutdown and restaurants being shut down, earnings did drop. It's going to expect it to drop by 9%. from 546 to 498, but picking up right up in 2021 at $7 and $5.78, 16% growth, and $7 in 2022, a 21% growth. So this company does present great opportunity as well. As you can see here, the dividend was flat throughout the early 2000 up to 2012 is when they started to pick up the dividend increase, but it's been growing very nicely here. So if we shorten this time period, you can see here the company is undervalued, a 26% total annual rate of return based on its normal multiple of about 13. You can see here is another company that presents a great buying opportunity. So again, just because the market is overvalued doesn't mean that there's pockets of companies that are undervalued and present great buying opportunity. You have a nice decent yield of 2.7. Earnings yield is slightly lower than the others, but still higher than my criteria of 6.5 or 7 and higher. Triple B plus credit rating, so investment grade, and a 42% modest long-term debt to cap ratio. So overall, Tyson Food Inc. TSN does look very nice at this price. So there you have it. Those were the 8 companies that I see that are undervalued even at this current overvalued market, like the S&P 500. S&P 500 is down about 2% right now. Is down almost 10% since the September 2nd. So that is kind of a market correction. But if a market crash does happen of about 20%, 25% down from September 2nd, these companies are very safe because they were able to go through the economic shutdown and continue to pay out their dividends as of now. And the dividend does look very well covered in these 8 different companies. So those are 8 companies that you guys should look into and do further research, because as you saw, great high potential rate of return. So thank you for watching. Again, if you're new to the channel, make sure to hit that subscribe button. And if you like this video, hit that like button as well to help for the YouTube algorithm. And I'll see you guys in the next one.